The day was March 15, 2023. It was a day that should have shut down every newsroom on the planet, a day where financial history bent, yet most Americans missed it entirely. The headline was small, buried in the business wires. Saudi Arabia would, for the first time in nearly 5 decades, accept the Chinese Yuan for oil sales to China. Not dollars. Yuan. For 49 years, the world's most critical commodity, oil, was exclusively sold in US dollars, the foundation of the petrodollar system established in 1974. On that day, that monopoly was broken. This was not a trade deal. This was not a diplomatic formality. This was a signal. It was a declaration of war, but not a war fought with missiles or tanks. This was stage 6 of an 8-stage collapse pattern, a historical sequence that has destroyed every single reserve currency that has ever dominated the global financial stage. We are talking about a pattern that spans 5 centuries of history. It claimed the Portuguese Real in the 1600s, sinking the vast spice empire of Lisbon. It took the Dutch guilder in the 1700s, shattering Amsterdam's reign as the world's financial capital. It dismantled the mighty British pound in the 1900s, signaling the irreversible end of the British Empire. And now, the exact same pattern, stage by stage, crisis by crisis, is consuming the US dollar. We are entering the most volatile, dangerous, and unpredictable phase, stage 6, where competitors gain critical mass, alternatives become easier to use than the dominant currency, and the collapse accelerates exponentially. Every previous dominant power refused to believe its currency could fall. They thought their system was too big to fail. They were wrong. Every one of them. The US dollar is not different. It is simply next. But this time, the collapse is being forced, accelerated, and methodically engineered by one nation in a silent war that is attacking the dollar's very foundation. This video is not about speculation, it is about pattern recognition. I'm going to show you the exact 8-stage pattern that destroyed 3 previous reserve currencies, and where the dollar is right now in that cycle. I will reveal the 5 secret fronts of the silent war this one nation is waging to push the dollar into stage 6. You will learn the specific mechanisms that are accelerating the collapse faster than any previous historical transition. We will look at who profits enormously from this shift, and who gets financially destroyed. And most importantly, I will lay out the historical timeline that puts the end of the dollar's dominance within the next 10 to 15 years. This is the most important economic story of your lifetime, and it is happening in plain sight. Before we can understand the silent war, we must first understand the weapon that is under attack, the reserve currency status itself. What exactly is a reserve currency, and why does the loss of that status mean a 30% to 40% reduction in your living standards? A reserve currency is the currency that countries and central banks around the world hold as their primary foreign exchange reserves. They do this for stability, to facilitate international trade, and to pay off global debts. When a currency achieves this status, it is handed an extraordinary set of advantages that are so powerful, they essentially function as an exorbitant privilege, allowing the issuing country to live above its means. If you think of a global economic system as a massive, interlinked computer network, the reserve currency is the operating system, the very code that governs all transactions. When you control the operating system, you control the entire network. This is the structural advantage that is currently eroding beneath the United States. To understand the scale of the threat, let's quickly look at how past powers achieved their currency dominance, establishing the first stage of the pattern. Stage 1 is dominance established through economic and military superiority. The Portuguese Real became the currency of the Indian Ocean trade because Portugal militarily controlled the critical spice routes around Africa, giving merchants no choice but to use the real to buy pepper and cinnamon. The Dutch guilder took over because the Dutch East India Company was the richest corporation ever and Amsterdam had the most sophisticated and trusted financial infrastructure, the world's first stock exchange and its most reliable bank. The British pound ruled because the Royal Navy controlled the seas and British industry dominated manufacturing, making Britain the centre of global trade. After World War II, the US dollar became the reserve currency because America had 50% of global GDP and its military was unchallenged. The 1944 Bretton Woods Agreement formalized this dominance, pegging the dollar to gold. Even after that gold link was cut in 1971, the dollar supremacy was maintained by the 1974 petrodollar deal with Saudi Arabia. Dominance is established through strength, but that strength contains the seeds of its own destruction. That seeds germinate in Stage 2. Stage 2 is peak power and overextension. At the height of their power, the dominant country always overextends. It fights wars it cannot afford, borrows excessively, and prints money to fund its imperial projects, all while maintaining currency strength through inertia. Portugal's small population couldn't sustain its global empire against rival European powers, draining its resources and forcing heavy borrowing. The Dutch fought repeated, costly land and sea wars against England and France, spending more on defense than they earned from trade. Britain fought the Boer War and maintained the world's largest navy, rapidly turning it from a creditor to a debtor nation. The USA, at peak power in the 1950s, fought the Vietnam War, forcing Nixon to end gold convertibility in 1971, and continued massive, non-stop military spending for decades, leading to a $10 trillion debt by 2008. In every case, the currency remained strong because everyone still needed it. The structural demand was still there, but the underlying fundamentals were being hollowed out. The stage was set for the silent war to begin. The final phase before Stage 6 is the transition that we have just completed, where the antagonist of the silent war made their first move. This is the transition from Stage 3 to Stage 4, and it fundamentally changed the calculus of the dollar security forever. Understanding this transition is crucial, because it explains why the one nation, China, is the single greatest threat to the dollar's future. Stage 3 is competitors emerge and build alternative systems. Other nations, watching the dominant power overextend and abuse its financial privilege, begin building alternatives. These are initially defensive measures, designed not to replace the reserve currency, but to reduce their own vulnerability. When Portugal was at its height, the English and Dutch East India Companies were founded. These were commercial rivals that built their own, more efficient trading networks and ship fleets, challenging Portugal's spice monopoly. The Portuguese Real was still used, but alternatives now existed. When the Dutch guilder dominated, London's financial markets, backed by the rising British Empire, emerged as a rival to Amsterdam. The Bank of England was founded, and the British pound began its slow, steady ascent. In the dollar's case, the 2008 financial crisis was the wake-up call. It demonstrated the fragility of the US system and the risks of dollar dependence. Nations like China and Russia saw the vulnerability and began their defensive build-up. China created CIPS, the cross-border interbank payment system, in 2015 to rival the US-controlled SWIFT network. Russia, similarly, created SPFS. These were not immediate replacements, they were lifeboats, built in the shadow of the dollar. This brings us to Stage 4, currency weaponization accelerating alternative adoption. This is the most crucial turning point. When the dominant power faces challenges, it inevitably uses its currency as a weapon: sanctions, asset freezes, exclusion from payment systems. This move is intended to punish enemies, but it inevitably backfires, accelerating the decline. When Portugal tried to exclude rival Dutch and English traders from its ports, the rivals simply built their own alternative trading hubs, forcing the Portuguese monopoly to crack faster. When Britain blockaded Dutch ports during the Anglo-Dutch Wars, Dutch merchants, unable to use Amsterdam banks, were forced to use London banks instead, destroying the guilder's financial dominance. Similarly, when Britain froze German assets during World War I, neutral countries realized the British pound was not a safe asset during conflict and began diversifying their holdings. Weaponization is the trigger that proves the risk of reliance on the dominant currency. For the US dollar, weaponization accelerated dramatically in two phases. The first was the 2014 sanctions on Russia after the annexation of Crimea, pushing Moscow to reduce its dollar reserves from $130 billion to near zero by 2020. The second, and far more catastrophic, phase was the 2022 sanctions following the invasion of Ukraine, when the US froze $300 billion in Russian central bank reserves and cut Russia off from SWIFT. This was the nuclear option. And it backfired catastrophically. Every single country watching realized, dollar reserves can be frozen. SWIFT access can be removed. Your national wealth is not safe if America decides you are an enemy. The result was mass de-dollarization. China began aggressively reducing its US Treasury holdings. Saudi Arabia reduced the dollar share of its reserves. Central banks globally bought gold at levels not seen since the 1970s. The weaponization that was meant to punish Russia instead convinced the entire non-Western world that they must build and use alternatives. The defensive measures of Stage 3 instantly became the offensive tools of the silent war in Stage 6. This leads us to Stage 5, which the dollar has been slogging through for the last decade. Confidence cracks and reserve share begins falling. After weaponization proves the vulnerability, countries actively reduce holdings. The dollar's reserve share peaked at 71% in 1999. By 2024, it had fallen to $58%. That's a 13 percentage point drop in 25 years. This decline is slow, consistent, and, historically, irreversible. The British pound share fell from $60% dollar in 1913 to $30% dollar by 1940. It took decades, but once it started, the decline was locked in. The dollar is following the exact same trajectory. We are now transitioning from the slow, steady fall of Stage 5 into the sudden, exponential acceleration of Stage 6, and this acceleration is being driven deliberately by the one nation waging the silent war, China. To understand why China is so effective in this war, we must understand the 4 structural advantages that losing the reserve currency status will take away from America. These 4 advantages are collectively known as the Exorbitant Privilege, and they are the 4 pillars that currently hold up the US economy. When these pillars crumble, so does the American living standard. The first pillar is structural demand. If every country needs dollars to trade internationally, they must constantly buy dollars, whether or not the underlying US economy is strong. This creates permanent, artificial demand that props up the currency's value. The moment countries can trade in another currency, this demand vanishes. The second pillar is seigniorage. This is the extraordinary privilege of being able to print paper, dollars, and exchange them for real goods from other countries, cars, electronics, oil. You trade paper for real wealth. When the dollar loses reserve status, that paper is only valuable domestically, and this free transfer of wealth stops. The third pillar is cheap borrowing. Because everyone needs your currency, they buy your government bonds. This lets the US government borrow at lower interest rates than its economic fundamentals would ever justify. It lets the US sustain a $36 trillion national debt that would bankrupt any other country. If this pillar falls, interest rates spike, and the debt becomes unpayable. The fourth pillar is exported inflation. When the US prints money, the resulting inflation is spread globally because everyone holds and uses the currency. This is why inflation in the US, while painful, hasn't been hyperinflationary. The world absorbs the excess dollars. Losing this means the US can no longer print money without causing immediate, catastrophic domestic hyperinflation. The silent war being waged by China is a direct, multi-front attack designed to dismantle these 4 pillars simultaneously, forcing the US into Stage 6. Alternatives gain critical mass. China's strategy is elegant, quiet, and absolutely lethal to the dollar system because it leveraged the vulnerability created by America's own past weaponization. The one nation has learned from the past collapses of Portugal, the Netherlands, and Britain, and is using that historical knowledge to accelerate the decline of the dollar. The 5 fronts of this war are operational now, and they are moving faster than anyone in Washington is willing to admit. We have to look past the military headlines and focus on the cold, hard numbers of trade, payment systems, and gold reserves. Only then can you see the full scale of the attack. We have established the vulnerability, the nuclear option of sanctioning Russia that proved to the world the dollar is a weapon. We have also defined the target, the 4 pillars of the dollar's exorbitant privilege. Now, we must dissect the battle plan. This is the silent war being waged by China, the one nation applying relentless, surgical pressure to force the US into Stage 6 of the collapse pattern. This is not a kinetic war. It is a meticulously calculated financial offensive fought on 5 distinct fronts, each designed to dismantle one of the 4 pillars of dollar dominance. The objective is to make the dollar irrelevant by giving the rest of the world better, safer, and easier options. The first front of the silent war is the payment bypass, and the weapon here is CIPS. CIPS, or the Cross-Border Interbank Payment System, is China's direct competitor to the US-controlled SWIFT network. For decades, if you wanted to move serious money internationally, you had to clear it through New York, meaning you had to use SWIFT, and you had to use dollars. This gave the US the absolute power to exclude any nation it chose, as it did with Russia. But China has created the alternative. The growth of CIPS is the clearest measure of the network effect flipping, the mathematical transition from Stage 5 to Stage 6. In 2020, CIPS processed roughly $12 trillion in transactions. By 2023, that volume had more than doubled, hitting an estimated $27 trillion. This astonishing rate of growth proves that countries are not just talking about de-dollarization, they are actively transacting in non-dollar currencies, and they are using China's infrastructure to do it. This bypass directly attacks the structural demand pillar, because if you don't need SWIFT, you don't need to hold nearly as many dollars. The second front is the oil deal flip, the most visible and politically explosive attack. This targets the petrodollar, the single bilateral agreement established in 1974 that has been the dollar's foundation for 50 years. The moment came in March 2023 when Saudi Arabia agreed to accept yuan for oil sales to China. While the volume is small now, the signal is everything. Saudi Arabia, the largest oil exporter and the historic anchor of the petrodollar, has diversified its geopolitical alignment and, critically, its payment currency. Why is China the driving force? Because China is the world's largest oil importer. By guaranteeing demand for oil paid in yuan, China is creating a credible, non-dollar oil market. Other major oil producers, including BRICS members like the UAE and Iran, are watching and already following suit. The message is clear: the only reason you needed dollars to buy oil is ending. This attack on the petrodollar is a direct assault on the structural demand pillar, accelerating its collapse. The third front is the debt weapon, a passive-aggressive yet devastating strategy. This involves China's steady and strategic reduction of its holdings of U.S. Treasury bonds. For years, China was one of the largest foreign creditors to the U.S., holding over $1.3 trillion in treasuries at its peak. This forced China to constantly accumulate dollars, reinforcing dollar dominance. But since 2013, China has been strategically selling down those holdings. This move serves two functions in the silent war. First, it directly reduces the structural demand for U.S. debt, which directly attacks the cheap borrowing pillar. As the biggest buyers leave the market, the U.S. government must pay higher interest rates to attract new buyers, making its $36 trillion debt crisis far worse. Second, by swapping dollars for other assets, particularly gold, it is a statement of no confidence in the long-term solvency of the United States. The fourth front is the gold fortress, perhaps the most significant long-term move. Gold is the ultimate anti-dollar asset. It is nobody's liability, cannot be sanctioned, and retains value when reserve currencies fall. The People's Bank of China, PBOC, has been quietly, yet relentlessly, accumulating gold reserves for years, often reporting only the bare minimum to international bodies. The official numbers are certainly underreported, but the trend is unmistakable. China is building a fortress of physical, non-digital, non-fiat wealth. This strategy is critical because the future of the BRICS financial system, which we will discuss in the next section, is rumored to be based on a commodity-backed currency. China's gold reserves provide the necessary foundation for that currency, giving it credibility and stability that a pure fiat yuan lacks. By building the gold fortress, China is simultaneously undermining the dollar status while preparing to launch a credible rival, directly attacking all four pillars by providing a physical alternative. Finally, the fifth front is the BRICS expansion, a massive geopolitical push to build a rival economic structure. BRICS, originally Brazil, Russia, India, China, and South Africa, successfully expanded in 2024 to include major oil producers and regional powers like Saudi Arabia, the UAE, and Iran. China is the economic and industrial center of this bloc. The goal is simple: to create a self-sufficient economic zone that can trade, lend, and hold reserves without using the dollar. The BRICS New Development Bank is an alternative to the World Bank. The BRICS payment system rivals SWIFT. And, most importantly, the BRICS nations are actively working toward a common currency, likely commodity-backed, to use in international trade. The political gravity of a bloc that now controls a significant portion of the world's energy and population is immense. This expansion is China's masterstroke, directly accelerating Stage 6 by ensuring that any country seeking to de-dollarize has an entire global system ready and waiting to receive them. The combined force of these five fronts is why the dollar's decline is not just a slow, historical rotation, but a rapidly accelerating event that could hit the crisis phase sooner than anyone expects. The historical parallels prove the pattern, but the silent war proves the speed. The transition from Stage 5 to Stage 6 is never slow. It is a rapid, non-linear jump driven by the flipping of network effects. Imagine two phone networks. Network A has 90% of the market share, and Network B has $10%. Even if Network B is technically better, you use Network A because all your friends are on it. That is the power of the dollar's network effect. But when a rival like China strategically launches 5 simultaneous attacks, the market share doesn't just erode, it flips. The moment Network B hits $40% or $50% share, everyone jumps ship because they can now reach more people, more reliably, and more safely. That is the essence of Stage 6. Alternatives gain critical mass, and the spiral accelerates. The silent war is designed to hit that critical mass, and to do it faster than any historical parallel. Why is this current transition faster than the $30 to $50 years it took for the real, the guilder, and the pound to fall? The answer lies in two major forces: historical accelerants and China's unique BRICS strategy. First, let's examine the historical accelerants that make the dollar's decline faster and more chaotic. The first accelerant is technology and speed. In 1914, when the British pound was beginning its decline, moving gold reserves between countries took weeks, ships, railroads, physical logistics. Today, billions in reserves can be sold, transferred, and converted into yuan, gold, or cryptocurrency in seconds. De-dollarization is no longer limited by physical logistics, it is instantaneous. Countries can dump treasuries and buy the Chinese CIPS in minutes. The logistics of collapse have been upgraded from sailing ships to fiber optics. The second accelerant is the multiplicity of alternatives. In 1940, when the pound was failing, there was only one credible alternative, the US dollar. America was the only economy large enough and stable enough to shoulder the reserve burden. Today, there are multiple, ready-made alternatives, the Chinese Yuan, the Euro, the Japanese Yen, and the commodity-backed BRICS currency. When confidence in the dollar breaks, central banks have a diversified menu of options. They don't have to wait for a single successor, they can hedge immediately, making the selling pressure immediate and global. The third accelerant is the artificiality of the petrodollar. The Portuguese Real, the Dutch Guilder, and the British Pound were all backed by genuine economic dominance, massive trade volumes, manufacturing supremacy, and sophisticated financial markets. The dollar's dominance since 1974, however, has been backed by one singular, political agreement with Saudi Arabia, oil only in dollars. That agreement was always vulnerable to political shifts. As we saw in March 2023, the moment the political relationship weakens, the petrodollar ends instantly. It was a political fortress built on sand, and China simply offered Saudi Arabia a geopolitical cushion. The fourth accelerant is the sheer scale of US debt. Portugal, the Netherlands, and Britain had debt problems, but nothing comparable to the current US national debt of $36 trillion, which is over $120% of GDP. The US economy has been inflated by decades of the exorbitant privilege, meaning the country lives beyond its means. When the dollar loses reserve status, America cannot finance this deficit. Interest rates spike, forcing the government into a brutal choice, either austerity, politically impossible, or hyperinflation, economically destructive. Previous declining powers could manage the decline gradually. America cannot. The debt guarantees a rapid, violent adjustment. The fifth accelerant is globalization and contagion. In 1940, a British currency crisis mainly affected the empire and a few trading partners. Today, the global economy is intertwined with $80 trillion in dollar-denominated debt globally. If confidence breaks, the selling pressure is immediate, catastrophic, and contagious to every market on Earth. This transition is not regional, it is global, and therefore, it will be faster and far more chaotic. These accelerants create the perfect environment for China's BRICS strategy to succeed. The BRICS alliance is not a trade agreement, it is a financial escape hatch. The core strategy is the development of a common currency, potentially backed by commodities and gold. China is the industrial power, Russia and the Middle Eastern members are the commodity and energy suppliers, and India and Brazil offer vast markets. This bloc is actively working to dismantle the need for dollars in two key areas. First, oil and trade invoicing. As countries like Brazil and Argentina negotiate bilateral trade in local currencies, and Saudi Arabia sells oil for yuan, the necessity of the dollar in these critical transactions evaporates. Second, central bank reserves. The BRICS alliance, driven by China's gold accumulation, offers a credible, neutral store of value. Why would a central bank in a neutral country hold US treasuries, an asset that can be frozen by Washington, when they can hold a BRICS currency or gold, which cannot be weaponized? This is the network effect flipping on a geopolitical scale. The dollar is no longer the safest or most liquid option, it is the most politically dangerous option. The decline is now visible in the numbers, proving we are exiting stage 5. In 2022, $73% dollar of international trade was invoiced in dollars. By 2024, that figure has plummeted to $58% dollar. That's a $15 percentage point drop in just 2 years. This is not historical inertia, this is the network effect flipping because of the silent war. Merchants are choosing non-dollar currencies because their trading partners accept them, and the payment infrastructure, CIPS, is ready. The spiral has begun. The US is now balanced precariously at the very edge of stage 6, looking into the abyss of stage 7, crisis acceleration and panic diversification. The timeline is no longer a matter of decades, it is a matter of a single, sudden crisis, triggered by either a policy mistake in Washington, a military overextension, or the successful launch of a BRICS alternative. We are standing at the threshold of stage 7, crisis acceleration and panic diversification. This is the danger zone. Once the network effect flips, the system becomes highly unstable. A war, a major financial crisis, or a domestic policy mistake triggers panic, leading countries to dump their remaining dollar reserves. The dollar crashes. The dominant power tries to stop the fall, but the alternatives, the 5 fronts of the silent war, are now too strong. When the guilder collapsed, it was the Napoleonic Wars that delivered the final blow. Amsterdam was cut off from its colonies, and the currency plummeted. For the British pound, the crisis was World War II, which left Britain bankrupt and indebted to America, followed by the humiliation of the 1956 Suez Crisis, which proved to the world that the pound was subordinate to the dollar. The crisis for the dollar is coming, and it will be triggered by one of 4 high-probability events, all being hastened by the silent war. The first crisis trigger is the BRICS currency launch. If the BRICS alliance successfully launches a common, commodity or gold-backed currency for international trade, it creates the first truly credible, neutral reserve alternative. Oil producers will accept it, and the remaining structural demand for the dollar will vanish overnight. The second crisis trigger is a U.S. debt crisis. With the federal debt at $36 trillion and interest payments soaring, if bond markets lose confidence, perhaps driven by China's continued dumping of treasuries, yields spike. The Federal Reserve will be forced to choose between printing money to buy the bonds, causing hyperinflation, or letting rates rise, causing a catastrophic depression. There is no good option. The third crisis trigger is military overextension. Simultaneous, undeclared conflicts, Taiwan, Ukraine, the Middle East, that fail to produce a decisive U.S. victory will crush global credibility. The currency is backed by military strength. If that strength appears ineffective, the currency is instantly devalued. The fourth crisis trigger is a banking crisis. A wave of commercial real estate defaults, for instance, could destabilize $500 to $1,000 regional banks. A loss of confidence in the U.S. financial system itself will send capital fleeing to safer havens, like gold or the yuan. Any of these triggers will send the dollar into stage 7, where it falls $30% dollar to $50% dollar against other global currencies in months. This brings us to the historical timeline, refined by the accelerants of the silent war. We are in the critical phase of 2023 to 2025, stage 5 to 6 transition. The next phase, from 2025 to 2030, is the absolute danger zone. This is when the BRICS currency is projected to launch, when more countries accept non-dollar oil payments, and when the dollar's reserve share will inevitably fall below $50% dollar. The network effect flips. Stage 6 is achieved. The phase from 2030 to 2035 is when one of the crisis triggers hits, accelerating the collapse into stage 7. The dollar crashes. The final phase, 2035 to 2050, is stage 8, replacement and new dominance. A new system emerges, either a multipolar world where the euro, yuan, and dollar all share power, or a new commodity-backed currency takes the lead. The dollar will remain a currency, but it will no longer be the dominant reserve currency, settling at $35% dollar to $40% dollar of global share. This timeline is not a prediction, it is an analysis of historical momentum and geopolitical pressure. The decline is locked in. The final consequence of this pattern is the great wealth shift. Trillions of dollars in purchasing power will be transferred from those holding dollar assets to those holding non-dollar assets. The winners of the silent war will be clear. Gold holders win massively. When reserve currencies collapse, gold surges. During the decline of the British pound and the end of the dollar's gold convertibility, gold saw $20 to $24 fold gains over a decade. The central banks buying gold now know this history. BRICS nations win, gaining economic independence and geopolitical power as they trade in their own currencies and avoid U.S. sanctions. Commodity exporters win, no longer forced to sell their oil, gas, and metals for a depreciating dollar. They can demand stable currencies or gold. Countries with low debt win, becoming capital safe havens. The losers will lose everything. America loses the most, as the decades of the exorbitant privilege end, forcing living standards to crash $20% dollar to $30% dollar as the trade deficit becomes unpayable. Dollar savers and bond holders lose. A $30% dollar to $50% dollar devaluation of the dollar means your wealth loses the same percentage of its international purchasing power. Your $1 million bond portfolio is worth $500K to $700K in real terms. Wall Street and big banks lose, as global transactions clear through Shanghai and Frankfurt instead of New York. The US government loses its ability to fund its massive deficits without causing crippling inflation. The 8-stage pattern has destroyed 3 currencies in $500 years. Each time, the dominant power believed they were too big to fail. Each time they were wrong. The US dollar is in stage 6, being relentlessly pushed by the 5 fronts of the silent war, led by China. The petrodollar broke in 2023. The signal has been sent. The network effect is flipping. The spiral accelerates. The time for denial is over. The time for preparation is now.